Hello fellow investors, I've screened household and personal product stock under the consumer defensive individually and gave you the best prices for each, and I explained why. Go check them out. This time I'm screening the whole of the sector, side by side, and I'll tell you the only household and personal product stock I'd recommend you buying. This is the table comparing the 7 stocks of the same sector, household and personal product stocks. These are stocks like PG, EL, CL, KMB, CHD, CLX, and NWL. If you want me to screen your stock of the same sector that's not included here, just comment your stock below. This is the current or latest closing price I'm screening them. PG $146.11, EL $256.52, CL $81.97, KMB $136.76, CHD $94.25, CLX $143.9, and NWL $19.51. This is the annual dividend per share they pay out to investors. $3.65 for PG, 2.44 EL, 1.88 CL, KMB 4.64, 1.05 CHD, 4.64 CLX, 0.92 NWL. Below each is the respective dividend yield. The dividend yield is the value you get for the price of your investment. It increases as the prices go down, meaning the cheaper you buy the stocks, the higher the dividend yields you can get, given that their dividends don't change. In my process, I consider buying stocks with dividend yields of 2% and higher. Below 2%, I really don't like buying them. I value my money that much that I'd only buy stocks with 2% and higher dividend yields. The higher the dividend yield, the better. By that process, I won't be buying EL stock and CHD stock here. EL with only 0.94% dividend yield and CHD only have 1.11% dividend yield. The stock with the highest value for your money right now is NWL stock at 4.72% dividend yield. Your assignment is to find out how much they changed their revenues. Did they change it for the better, meaning increasing dividends, or they issue different dividends over the years depending on their earnings? Because as investors, you want some dividend safety and stability. Below dividend yield is payout ratio. Payout ratio is dividend divided by the EPS. The higher the payout ratio, the worse it gets. Because then, they would have to burn cash, issue debt, or dilute shares in order to just sustain those dividends. We want a payout ratio below 60%. And again, it's just NWL that's looking attractive here. 54.76%. Next is Guru Focus's intrinsic value for the stock, and below that is the percentage of the current price from the intrinsic value. PG stock would have to slash 57.27% of the current price to get to Guru Focus's intrinsic value. EL stock has to drop 74%, CL stock 57%, KMB 58%, 46% for CHD, 54% for Clorox, while NWL stock is within the buy range of Guru Focus's intrinsic value. That means NWL stock is the most attractive if you're looking based on Guru Focus's intrinsic value. Now, below the intrinsic value is my process, my fair values for the stock. $86 for PG, implying a 41% downside from the current price. $94 for EL, 63% downside. $31 for CL, a 63% downside, etc., etc. Now guys, I screened these stocks individually last couple videos, and these prices here don't necessarily match those you see in the thumbnails, and that's why I recommend you watch those individually, and you'll find out why I have those numbers in the thumbnails. Now guys, from seeing these values here, this is why I think this sector is a bubble. This is what happens when people don't sell. And yes, I somehow believe passive investing could be a bubble or could create a bubble. Why? because companies cannot catch up to buying back shares to level the fundamentals from their current valuation. They would instead increase the dividends to keep the buyers from selling, ergo, creating the term dividend bubble or dividend traps. You shouldn't fall for this. Some point in time, the owners of the stocks would sell and they'd only buy back when the prices match their fundamentals, and you'd get a lower value for your money, all because you FOMO at the top or because you bought expensive. This is their margins. PG, CL, and CHD makes the most of their revenues, 14 to 18% margins. This is their current PE, current price of free cash flow, and the current PB ratios. In my process, the PEs should match their margins. Remember, I pay 1 PE for 1% of their margins. This is why the stocks are overvalued because they're trading at 2, 3, or even more times their margins. Price to free cash flow, I really don't mind because I have an allowable of 20. All of them trade above 20, which is bad. PB ratio, I have an allowable of 5 and only NWL stock is within my buy range for PB ratio. Share buyback, PG stock bought back the most shares, 154 million in 5 years. Debt level is low for PG and EL stocks. High debt levels for KMB and NWL stock. This is relative to the money they're making, okay guys? While manageable for CL, CHD, and CLX. Don't pay premium for any of the stocks. They're not growing as much. Single-digit revenue growth. Some have capped revenues. These stocks are trading at a moat multiple, not necessarily growth multiples. The moat for PG is strong while the others I only rated good. Now, the verdict, this sector is the bubble. Bubbly, overvalued, trading at a moat premium. At the current prices, I don't recommend buying any of the stocks. I don't recommend adding to the stocks either. I'd like you to watch out for PG at 5 PB. The equivalent price for that is $95. Put an alert on that. But I'd only recommend buying it below 91.25 so you get your 4% dividend yield. Given that PG stock is still bullish or still on its bull run. Once it reaches $95, investors are gonna get greedy and bring the prices back down to $90. So get those yields, but it's a long way to go from the current price of $146. Again, fellow investors, these entry prices could get better depending on the EPS or margins they put out quarter over quarter. But at the current state of their financials, these prices are the most logical prices to pay for in each stock. For now, if you own these stocks, I think you should just enjoy the dividends and enjoy the bull run. I'd recommend you put stop losses on some levels and secure your gains, and only buy back into the stock when the fundamentals match their current valuation. That's my take on this sector. Household and personal product stocks, overvalued in whole. See you next videos. I'm screening more of the consumer defensive.